Stream. It's good to be with you on this lovely Thursday afternoon. I want to talk about the FOMC meeting yesterday. The Federal Reserve raised interest rates another 75 basis points. So now we are in that 4% ballpark. But more importantly, I want to discuss how the reaction after Fed Day is more important than Fed Day itself. Fed Day is a highly emotional day for traders, the algorithms. If you don't realize that algorithms can be emotional, it really all comes down to the programmer. But the point I'm trying to make is that how the market reacts the day afterward historically tends to be more important than the day's reaction. So without further ado, let me go ahead and share my screen here, and we can start looking at some charts. Let's begin with the S&P 500 here. You can see that we were up for a decent portion of the day on Wednesday, but at first the market liked the 75 basis point rate hike, but Fed Chair Powell came out and said, no, there is no pivot yet. Even though, one can make an argument that the market, the federal funds expectations tends to disagree. But in any event, markets plunged after the press conference, and we closed near the lows of the day, erased a few days worth of gains. And then here on Thursday, prices gapped down. We're trading lower, recovered some a little bit, but now we're basically back to where we opened. So we're in a very precarious position, going into, we have our final trading day of the week on Friday, tomorrow, obviously, but pretty precarious position, because what I'm going to do in a moment is zoom out, because, there's a very useful adage in trading: when in doubt, zoom out, because as a rule, the longer term trends tend to overpower the shorter term trends. Now, of course, when the trends actually change, the shorter term one will change first. But the point I'm trying to make is that, if we can hammer out a higher low here, there is, still some possibility for bulls to make a stand. But my bigger concern is on the weekly chart here, looking at, the fact that we took out last week's high and have pretty much erased and more of last week's gains is a concern. That being said, October was a very constructive month for equities. Bigger picture, we're still consolidating within this descending price channel. So, just like any other price pattern, until you actually start to emerge from it, it doesn't really mean much. But at the risk of forming another lower high here, this would serve to reinforce the existing downtrend that's been in effect for pretty much, basically ever since we made this lower high in March. Or took out this low from December or November of last year in February. So if we make another higher low here, I think we're probably headed to new lows in the S&P. But if bulls can make a stand and possibly bid the market up off the lows of the week between now and the close on Friday, I don't think all hope is lost with respect to the bullish case. I did see a pretty interesting factoid that I retweeted on the Twitter page, was that a tremendous amount of put options were bought. Basically, yesterday's press conference scared the shit out of a lot of traders, and a lot of market participants bought protection. A lot of times when you see that type of panic reaction, you don't see that the market follow through in that regard. So let's take a look at the NASDAQ here and look across the other major indices. NASDAQ leading the way lower. Again, this has been the theme throughout this year. Tech and growth underperforming, and the billion-dollar question, arguably even the trillion-dollar question with respect to equities going forward, is: are we in a new normal whereby growth and tech are not the market leaders? The 2010s were dominated by mega cap tech stocks. The FANG acronym: Facebook, Apple, Amazon, Netflix, Google. Those stocks dominated and pretty much gobbled up so much global capital during their impressive bull runs throughout the 2010s. But that was when inflation was at a very low level, and now that inflation's at 40-year highs, the prospects for growth just isn't going to cut it for investors going forward. We need to see tangible results. We need to see tangible cash flow, positive cash flow, earnings growth. The prospect for growth and future earnings just isn't going to cut it. We need to see something tangible, and that's not uncommon to see when you are in an inflationary environment. So the question becomes, are we going to see new leadership come out of any low that forms in the market. It's not a matter of if, it's a matter of when. The market will come back at some point. But the Nasdaq is looking the weakest by far. And again, I think the bigger question, if stocks can find a secondary high or low here, is will the Nasdaq continue to lag going forward? I do think so, because especially when we look at the Dow, at one point the Dow was up pretty nicely today. Looking at a weekly chart of the Dow looks much better, compared to the Nasdaq. The Dow rallied over 15% from its low back at the end of, actually, it was mid-October. But the Nasdaq barely even made it 11% off its low. So seeing the Dow outperform like that for the last 10 years has been a risk off signal. So is this still the case? That remains to be seen. But I think the bigger story emerging from the low that we saw in October thus far is the leadership from small and mid cap stocks. So, the mid cap index, S&P 400, was up, 12 and a half, almost 13% from that low. And it did, let's see, I have to zoom in a little bit here because I know that the Russell 2000 didn't take out its low from, let's see, the low in June 16th was 2187 and 2185. So we did slightly take out that low in September compared to June. But you can see here how the mid cap 400 is up on the day. Again, we're seeing basically smaller segments of the market outperform. So, throughout the 2010s, bigger was better. That's not uncommon in a deflationary environment because these larger companies have, eventually there's diminishing returns to scale, but they have the ability to scale up more effectively on the way up compared to their, small and mid cap counterparts. But another point worth mentioning is, this dollar strength that we've seen since it bottomed in May of 2021. A lot of times dollar strength corresponds to greater equity outperformance by companies that don't have as much, business internationally. Obviously, these multinational large cap stocks, they have a lot of their business overseas. And, when the dollar's strong, there's not as much activity or basically they're not exporting as much because it costs more for foreign countries to buy those goods or services. So, now that the dollar strength looks to be hanging around a little bit, that doesn't mean we won't see a consolidation or correction. In fact, we'll look at that in a moment. I do think that's still in the works. But I think the bigger story going forward is the prospects for outperformance by small and mid cap stocks. The Russell 2000, looking at the ETF here, IWM, never took out its lows from mid-June. And that's a really strong, powerful technical signal. So ultimately, stocks need to get back above their highs across the board, whether we're talking about the S&P, Dow, NASDAQ, mid caps, small caps. Until we take out those highs from mid-August, the trend is down. We need to see a significantly higher high form. And again, I think the fact that we did not take out the June lows in small cap Russell 2000 is a pretty strong technical signal. But, where else are we seeing strength across the globe? We've talked about Turkish equities and how the Central Bank of Turkey has been actually easing. And you can see this strength continuing this week. So we're still a big fan of Turkish equities, up 3% in the week, holding this bullish breakaway gap here. I think that Turkish stocks are probably some of the most attractive in the world right now, not just from a valuation standpoint, but just from a monetary policy standpoint. We've had our eyes on Brazil as well. They just had elections this past weekend. And Brazil's holding up well, but I do think Turkey is going to provide a little bit more alpha, so to speak, because, Turkey's been grappling with inflation for several years now. So, not to discount the worldwide inflation taking place right now, but Turkey's kind of just been dealing with it. They raised interest rates and I think north of 20% at one point. It was in the high teens, but they've been easing for quite some time now. And that is definitely a tailwind for their equity market. So I want to take a look at bonds real quick. We can take a look at the 10-year interest rate, still consolidating near its highs here. Although I do think that, if we do form any sort of secondary low or high here, any relief rally in bonds is a tailwind for equities just to kind of assuage some of those liquidity fears. We can take a look at the dollar ETF here. This is a pretty strong day so far. It looks like we're about to resolve back higher from this descending price channel. So, if so, then I think the equity rally is more in turmoil. But if this high continues to hold, from September, then I do think that, stocks can still make something happen here in the short term. Keep in mind, we have the U.S. midterm elections next week. A lot of times volatility spikes around that time. A couple key cycles are pointing to, potential. We're kind of on the precipice of the orb of those cycles unfolding, the week of the election. But there's a lot of signals that, it could be pretty consequential for financial markets, like all elections are. But I think especially as it pertains to energy and inflation going forward, we need to account for domestic energy policy and how that's impacting inflation. So, it's more complicated than just saying, oh, we're just going to transition to green energy right now. We have demand that needs to be fulfilled in the immediate term. So, releasing oil from the Strategic Petroleum Reserve, we're now at levels not seen since 1984. I do think at some point the feds will have to buy that oil back, and that is going to be a tailwind for energy prices. And in fact, if we go across the board and look at some oil stocks, still some of the strongest performing names in the market today. Again, the themes that we've been hammering in the last several weeks, energy and healthcare continue to be some of the displaying some of the most notable strength underneath the surface. So there are some positive developments underneath the surface. Again, I just think that the biggest risk for markets is the unwind of the growth / tech trade of the last decade or so. So we're looking at Marathon Oil. That looks pretty good here. You got names like Occidental Petroleum, which Warren Buffett has been accumulating positions in. We had this massive multi-month long ascending triangle formation continuation pattern, which tends to resolve in the direction of the underlying trend. You start to close above resistance here, look out above, because I think it's going to look really bullish. But a couple other stocks we've shared recently for members have been stuff like Chart Industries. This is they actually do equipment. They do cryogenic storage for oil and gas products. So, looking at themes related to the energy complex can provide some opportunities too, but this one's up pretty nicely this week as well. But even if we look across in the healthcare sector, Neurocrine Biosciences seeing a lot of strength in this one. So that's what I mean. It's not all doom and gloom on the indices. It's more, it's a market of stocks more so than a stock market. There's always a bull market somewhere, but keeping in mind that 80% of stocks tend to move together. So that's all that I had the time to talk about with you today. So hope you enjoyed the stream. It's always a pleasure to hop on and discuss markets with you. If you're interested in my work, you can find it at www.mmacycles.com. I'm a contributor to several reports with my friend and colleague Ray Merriman, and also at www.benzinga.com. We have a chat room through there, and as well as periodic stock picks and a weekly insider report for members of Benzinga Pro. So thanks for watching. I will be back next week, same time. Well, not same time, but definitely same place. So